In the past 2 decades, China's fixed asset investment and infrastructure party has seen steel production jump from 100 million tonnes to 850 million tonnes, annual average growth of 11%. Unfortunately, internal demand hasn't been able to keep pace, and with residential construction under pressure and a refocus on the service economy, it seems China's steel consumption could remain flat at around 750 million tonnes per annum for the balance of this decade. This implies China's steel production is likely to exceed its steel consumption by at least 100 million tonnes per annum for some time. And while this steel hangover may soon become the consensus view, it appears to now be reflected in many underlying commodity prices and exchange rates. Spot metallurgical coal prices have declined 75% in recent years to the current $86 a tonne. Iron ore has come back from US $187 a tonne in early 2011 to the current $55 a tonne. Steaming coal, which helps generate electricity, is hitting 8-year lows. Oil and gas prices are challenging 10-year lows, and copper is at a 6-year low. The exchange rates of major commodity producing countries have taken a beating over the past 4 years, with the US dollar buying 128% more Brazilian real, 120% more Russian ruble, 83% more South African rand, 46% more Australian dollars, and 38% more Canadian dollars. While many commodity producers are enjoying the lower exchange rate, they're also working hard to get their cost base down. But in most cases, the underlying commodity prices have fallen more aggressively. Let's take Rio's latest half-year results as an example. Underlying earnings declined by $2.2 billion, or 43% to $2.9 billion. The weaker exchange rate, stronger volumes, lower operational costs, lower exploration costs, lower energy costs, all helped underlying earnings by about $1.5 billion. However, this was dwarfed by significantly weaker commodity prices, which subtracted $3.6 billion from underlying earnings. Investors in the retail sector should ask 2 questions at this juncture. What will happen to the share prices of the large bulk commodity producers if, for example, China continues to produce 100 million tonnes more steel per annum than it consumes? And second, what will happen to the supply of various commodities if relatively highly geared producers are incentivised to increase their production from their higher quality reserves, thus amortising the high interest expense across greater volumes? Please continue to follow us on Facebook and Twitter.